Right, a little bit of feedback on your exam from the other day, so you can work through it individually, pause it when you want and go into your revision guide, etc., and do some more reading when it's appropriate. So first one, which one of these is revenue? Well, revenue is the money coming in via sales when they sell bikes. So what's in the till? So we know that it'd be bike sales. Advertising, we'd have to spend, so that's money going out. That's a loan from a bank, so that's not money coming in from sales. And then obviously staff wages, again, is a payment rather than something coming in. So I give two examples of variable costs for this particular printing business. So I've gone for sort of the card, because the more cards you make, the more card you would need to actually create the actual piece or leaflet itself. And then you could have something like packaging, because when you package it, the more cards you make, the more you've got to package. You could have things like ink as well, maybe something like that, because the more cards you print, clearly the more ink you're going to have to use. Remember, variable costs are costs that rise or fall in relation to output, and that's the thing, it's in relation to output, so in relation to how many you make. Next one, which of these is a startup cost? Well, a startup cost, these are the costs that you have before you open the business's door for the first time. So before the business becomes open to the public, you've got to actually prep everything ready to say, right, here we are. This is what we sell, and you can come in and buy stuff. And then the running costs, they're the costs that once you have opened on the first day, they're the costs that happen continually going forward on day 2, 3, 4, 5, and years to come. So the running costs are the costs that keep it going day by day. So what we'd have is, well, we've got that as a startup cost because you need to put them in before the customers turn up. Paying wages, well, that happens, on day 2, day 3, day 4, day 5. Advertising for the opening, well, you need to do that before the opening day. And then heating, that's something that you do every day after the opening day. So that's how you would rig those up. So next question, you've got, for complete the table using the information above. So the variable costs, well, we sell 500 units at £10. So if we do that, we know that we put in 5,000. Right? Well, the fixed costs, they stay the same regardless. So the fixed costs we know are 4,000. If they sell more items, what happens to the fixed costs? Absolutely nothing, because they're fixed. They don't change in relation to output. Don't change in relation to output. That's the key, really. So next one, calculate the revenue. Well, revenue is literally the selling price times units sold, right? So we've got two figures. I mean, it's quite self-explanatory, because basically, I should have put this down here, sorry. Times 250. That's going to give us 125, isn't it? With how many zeros? 4. So you just do those two times together. Right, fairly self-explanatory, because that's what would be in the till at the end of the day's trading. There's only two figures, so you probably have to times them together. Right, next one, outline the difference between budgeting and budgetary control. Right, I think this is quite tricky, really. First, we'll take budgeting. I say this is financial plan for the future, looking at costs and revenues. Right. Then if we look at budgetary control, I feel this is the process used to manage the money passing through the business. So budgeting is looking at what's going out and what's coming in, but budget control is actually the process that makes sure, hopefully, that there's more of these and less of these. So budgeting is just what's coming in and what's going out, and it's making predictions and hopefully hitting those targets, whereas the budget control is basically trying to keep costs down and revenues up. Explain one advantage of business creating cash flow forecast. It allows managers to apply for sources of finance. Basically, if you see a month where you're going to not have enough money to keep trading, you can then apply for an overdraft. If you didn't do a cash flow forecast, then you wouldn't know to apply for an overdraft, and you might have to stop trading, etc. Just have a quick brew. Tea bag's still in this, so it's getting a bit strong. Next one, define the term break even. Well, the way I do this is I just define the formula. So I say it's the point at which total costs are equal to total revenue. So basically I've just given a definition of that. The point at which total costs is equal to total revenue. Right? And then we drop down to the next one. We've got to show the break-even point. Well, we know it's there. So if you drop that down, I think that's about 640. Right, so you just drop it down onto this line and just do that there. That would give you the 1 mark. So the break-even point is where you can see here, break-even, TC equals TR. TC equals TR. Well, the equals there, they're the same there. TC equals TR because the two lines, TR and TC. So where are they equal? Well, they're equal where they cross. So then you draw it down to get the units. Right, next up we've got, I think this is question 8, is it? So which ones of these are cash inflows? So this is money coming into the business, right? So sales income, because it's obviously coming in, and then the more tricky one is share capital. Share capital is when the business is set up as an LTD or PLC, and basically they need to raise some revenue. So this is the business, and what they do is they chop the business up, not physically, into little shares. So it's a piece of paper that you can buy, a member of the public can buy a share, and what they do is they now own a small part of the business. But for that, they would give the business a payment for that share. So you get money from sales, but you also get money from people buying a share in the business. And then you can, but the business would do that, it would sell shares because then it can expand and become a bigger business. It could buy a bigger warehouse, for example, but still have all the business cut up into its various shareholders. Right, next one, identify the point of profit. Well, the point of profit is where actually total revenue is higher than total costs. Right, so total revenue here, well, it's lower than total costs, it's lower than total costs, it's lower than total costs. Right, at this point, it becomes higher than total costs. So anything here is profit. Because at that point, the TR line gets higher than the TC line. Right, what is the total revenue if the business sells 800 units? Well, let's try it. So 800, go along to 800 and we go up, and it wants the total revenue. So just basically go up until I hit the total revenue line. There it is, and then go across. So it's going to be, the answer to that one is 3500. So if you're to sell 800, if you want to find out the total revenue, just go up until you hit the total revenue line. If you want to find the total costs when you sell 800 units, you just go up until you hit the total cost line. And actually, you can then work out what profit is, because it's the difference there in between those two lines. So at 800 units, you would actually be making 50,000 profits, because you have total costs of 300,000, you have total revenue of 350, the difference is that. So that would actually be the profit at 800 units. So the break-even graph allows you to do a lot of those things. Next over, so we are on question 10 here. Question 10, this is when things start to probably get a bit tricky for some people. So basically we've got to transfer a lot of these numbers into this bit, but with a change. So they've had a change in October. So we can put in the things that haven't changed. So the only thing that has changed is a payment in October. So receipts haven't changed, so we can stick that in. And we can stick that in because we know that hasn't changed. The only thing is a payment in October. Right, so here's the payment. So that's the one that we need to change in a minute. We'll leave that one. But everything else has stayed the same. So if we've got a payment now of 3,500 more than what we had here. Right, so if that is the case, well, if we were to add 3,500 to that, that gives us 11,950. And then we look at the difference. So it's the difference in this. This is the money coming in. This is the money going out. So actually it's a negative number because we've got more going out than we have coming in. And that is 2,700, I think, if I'm correct. We've got our opening balance there. So if that's what we have in the account, and then we've got that going out, it's going to be a negative again because we've got not much in compared to what's going out. And that would be 960, because have that minus that figure gives us a negative number. So the closing balance becomes the opening balance of next month. Again, we need to find the difference here to find the net cash flow. So the difference between those, well, we've got more coming in than we have going out, so it's going to be a positive, but not a big one. Is that right? 1,500, so that'd be 60. Yep. And then basically, if that's our opening balance, so we've got a negative opening balance, we've got negative 960, but we actually add some to that to make it slightly better, but it would still not be great. That would give us our 3 marks. That might be one that you have to stop and work through and maybe ask me, because that's quite tricky, but it is worth 3 marks. The only thing that changes is that bit there, and then you have to do the calculations. So don't get too confused. It's just one change and then how it affects the rest of the account. Number 11. Right, so it's basically using the information cash to recommend one action. Basically, overdraft. You know you need an overdraft because these figures here, they're negative numbers. You've spent more than you have, so you need to have gone to the bank to get an overdraft to allow negative spending. Basically, explain how the action will benefit the business. Basically, if you didn't have the overdraft, you'd have to stop trading, because you wouldn't have any money. But the bank's given you effectively a short-term loan to allow you to keep trading. Short-term money it's given you. Without that overdraft, you would have to shut your doors and not take any orders from customers. Right? So it'd be an issue. Next one, let's have a look at break even down at the bottom here after a quick sip of my brew. So they've actually given you the formula. They don't do that in our exam, unfortunately. But we can just simply stick stuff in the formula. So the fixed costs are at the top. 12,000. What question are we on here? 12. And then what do we stick at the bottom? Well, we stick selling price of 1,800. So if we just take this down here, because it's a bit more clearer, well, we take those away from that gives us 200. Divide that through, and that gives us, basically, we have to sell 60 tellies. The moment you sell 61 tellies, you would make a profit. If you sell 59, you would be making a loss. So 60 is the amount you need to sell. Video's getting pretty long, but hopefully it's beneficial. So using the formula, calculate how you would calculate profit. Well, profit is the money in, so we've got revenue, and you would take away the money going out, so expenditure. That should be quite straightforward. Don't confuse that with expenses. So expenditure is the money that's going out. You're spending, expending, so that's out, and that's the money coming in. So if what comes in, what goes out, that leaves us with the overall profit. Right, when we look at this, a cost of sales. A cost of sales is basically, it's a cost linked to manufacturing, usually. Manufacturing the product or delivering the service. So to actually make the goods that we are going to sell, we need the raw materials. So that's the one we want, the raw materials, because without them you can't actually make the, let's say, furniture that you're going to make with the wood there. Voice is starting to break a bit and crack up like a teenager, so quick brew. Lovely. Next one, number 15. So which of these two are assets? Assets are good things. If you have an asset, it is good. Like people have assets. You might be bright, or you might be good at football, or you might be quite good with numbers, or you might be quite fast, or whatever it ends up being. But assets are good things. There's good things for businesses as well. So a good thing would be equipment. Right, you've got equipment, that's good, it's worth something to you. It has a monetary or money value that can be sold on if need be. Customers who owe you money, that again is a good thing because they will pay you in the end. If they don't, you'll have to chase them and take them through the courts of law. So there's the two there for the 2 marks. Next one, explain 2 ways in this business can improve net profit. Right, well, there's 2 basic ways. Increase your revenue. And that's basically that, your sales of products. So you could increase your revenue, try to sell more basically, because then you've got more in your account before you start taking costs away. And the next thing is to reduce costs. So it would probably be quite difficult to reduce wages because of minimum wage, probably quite difficult to reduce rent, but you could. The best one would be cost of sales. And the way that you'd do that is you'd negotiate new deals with suppliers. Right, that's going to be that'd be really beneficial. So we're getting quite close to the end now. This one gets a bit trickier. So you've basically got to fill in this income statement. So income from sales, we know we'll drop that in there. Income from sales, because that's right at the top. That's the money before we've taken anything away. So 68500. Cost of sales, we just drop that in there. So that'll be, put that figure there, and then we do the gross profit. Well, it's this figure here minus this one here. And off the top of my head, that would be 30. I should have music calculator. 30. You'll have to check this. 30. I think that's right. So that minus that equals the gross profit. So that's just after you've taken away. They're just your variable costs. They're so things like your raw materials. We'd then put in our wages into there, which are 12,750, and we'd put our vehicle into there, which is 850. And then you'd basically add those 2 up and take them from that one there. So that minus those 2, again I should have used a calculator, 20, 21, 22, I think, but again, just check my maths on that. And that gives you a net profit, and that's basically the profit you would have to use. You could either reinvest that in the business, or maybe you pay shareholders or something like that. Right, the last one, number 18. So quite a few marks. Explain 2 short-term actions. So things that you could, if it says short-term, it's within a year. What could you do within a year to make this better? I think the two you would discuss is reduce your overdraft. You'd want to pay your overdraft. Overdrafts are good, however, they do come with interest. So if you don't have one, it's good because you're not paying an interest payment. And I would also, so that would be this one here. You'd be reducing that £900 to maybe 500 or something like that. And the next one is these trade receivables. So trade receivables, that's basically customers that owe you. So you've made the product, you've made the sale, you've done everything you need to do, you've printed the stuff, so this small printing business, it's produced the leaflets and it's sold them, it's given them to customers, but the customers owe you 3,500. So you need to reduce that, you need to get that money. Go and send them invoices, give them phone calls, email them, basically saying, pay me. And I think we're on the last one. Discuss the use of planning tools such as break-even analysis in managing. So this is a big 8 mark one. So basically here you would talk about break-even, and it allows you to track your total revenue versus total costs. It allows you to set targets for your sales force. So you could say, right, break even is 800. We need to sell, let's say 900, and then you've got a margin of safety of 100. So it sets targets. You could also look at budgeting, and that allows you to operate efficiently, because you can't spend more than you have. So a budget allows you to tell departments what they can spend. So marketing might say, right, we need a new advert, and you would say, right, well, your budget is 50,000, and they can't go above that, so you don't go bankrupt. You could also look at profit and loss. That allows you to see whether you need to, is there an opportunity to reduce your cost of sales? Is that the thing that's killing you? Have you got too much cost of sales? Are you spending too much on raw materials? Or is it your overheads? So if you're paying too much on rent, could you rent space to someone else? We could discuss this one in class because it's a longer one and more tricky. But that's everything all wrapped up. Hopefully you've understood a lot of it.